Thanks for tuning into the Portfolio Manager. I am Niraj Shah. Our guest today is Sumit Agarwal, Senior Vice President of Equity at Bandhan AMC, who runs the Financial Services Fund at Bandhan. And they have some very interesting overweight, underweight positions as well as allocations done to various facets of the financial services space. And we'll try and get some insights into why that is the case. At least in some very interesting ones that I've seen. But first, let's get his sense of how does he feel about the bucket at large. Sumit, great having you. Thanks so much for taking the time out. Are you constructive financial services currently, or is it, or as a house, you guys believe that there are better pockets to play in?
Thanks, Niraj, for having me on the show. See, one thing is quite clear that while the larger banking piece has clearly underperformed the broader market in the last 3 years, and within the overall ambit of financial services, there have been pockets of various other subsegments, or maybe even in the banking side, if we see, especially the PSU pack and some of the other names, those names have actually outperformed. And this kind of corroborates with a global rally probably in the last 2-3 years in the value cyclicals. And that has probably led to kind of performance that we have erstwhile not seen for a long time. And that is where we think that probably in the medium to long term, the current valuations for overall financial services, if you pick and choose wisely, are at quite attractive levels. And if someone has an eye for bottom-up stock picking, they can very well construct a portfolio which is very different from the index or the benchmarks or the typical heavyweight positioning that we see across diversified funds. And at least that is what something which we have endeavored to in this fund, and we have constructed a portfolio which has been very different as compared to all the peers as well as the index. And in the last, last few months since launch, probably, we have seen some fruits of the stock picking.
Okay, fair call. Now, I was looking at, I'm deep diving straight into the sector allocations. I'm going to dwell a bit on that. And I'll start off with banks, wherein the weightage in the fund is 42.5% versus the weightage in the index, I believe, is 76, which means that you are underweight banks, nearly a third of what the weightage in the index is. Why would that be the case?
Yeah, so fair observation. But the thing is, if you look at the construct of the index today, be it, let's say, the most prevalent index in the market is Bank Nifty or a Nifty Financial Services Index. My belief is probably they do not represent a lot of opportunities that this sector actually presents. For example, a Bank Nifty just has about 12 stocks. And similarly, Nifty Financial Services, it has about 20 stocks. So if you look at the construct of those stocks, maybe Nifty Financial Services do have a couple of insurance names and maybe one asset management company. But then there is a whole host of subsegments to play, which is not represented in the index at all. So therefore, if you invest a lot of money hugging the benchmark and be very lopsided in the top heavyweights, which are generally banks, it would be difficult to create alpha because, first of all, this space itself is not performing. And at the same time, you have an active money which you can deploy. But if you're hugging an index, it's very difficult to perform differently from the index. And on the whole, it also gives us flexibility to deploy the money in different baskets. For example, the entire private sector retail space, since last 1.5 years or so, since the rates have gone up, is slightly struggling because there's clearly pressure on liquidity. Deposit growth is struggling. And at the same time, there is nudge from the regulators as well to banks and institutions to actually reduce their LDR ratios. So clearly, between credit growth, asset quality, and margins, probably we are scoring fairly well on credit growth and asset quality, but margins is something which has been a weak factor at work. And therefore, we have taken a conscious call of being underweight in this sector. At the same time, whatever allocation we save from under allocating is deployed into other performing sectors and various other sub-segments, which I can discuss later on.
So would you say that, so am I to assume that it's largely because of the construct of the index the way it is that you have these weightages, else you're not negative banks, because again, your top overweight positions that I see per se, I mean, and I don't want to talk specific stocks with you, but I'm just giving this as an example because it's a declared fact sheet that with an ICICI bank or an HDFC bank be having such a high weightage, you clearly overweight banks per se individually. So it is only because of the nature of the index that it comes across as an underweight.
Yeah, very fair observation. In fact, structurally, if you ask me, for the next 3 to 5 years, I think banking as a pack is placed very well. Because clearly valuations are no longer premium what they used to be. In fact, the leading banks are trading somewhere close to 2.5 times price to book versus 3.5 to 4 times price to book. And at the same time, fundamentally, we did not see any pressure on asset quality. In fact, it has been one of the healthiest times for the Indian banks currently in terms of asset quality. Credit growth is actually picking up. You see a lot of pickup in industrials and capex, and after a long time, you're seeing even a commodity revival, which in a way is good for credit growth perspective. Only thing which is weak, I said earlier, is little bit on the liquidity. But going forward, let's say if you have a view over next 1 year, overall rates should actually be lower than what we are today. That would be NIM positive in my view. So again, all these three engines of growth will be at play for the sector, and at the same time, the private sector banks probably are at much reasonable valuations. So all these four factors coming together, I think bodes quite well for this pack as a whole. See, I would like to compare it with a situation of, let's say, what a PSU banks were about 2 to 3 years ago, wherein asset quality problems were behind. There was adequate capital available. And clearly, credit growth, I mean, they have been growing in line with the system. But valuations are very supportive, and that's why we saw PSU banks rallying from half time price to book to maybe close to 1 time price to book or slightly over today. And that pack has been a clear outperformer in the last 2-3 years. So I see a similar situation in the private sector banks today. Obviously, as investors, psychologically, it's very difficult to buy something where you think the near term there is a problem because of the margins pressure or liquidity pressure. But I think that is when the maximum amount of money is made if you have patience for holding on for a bit longer time.
Sumit, so okay, can I just ask you, therefore, the summation you're right, from COVID lows, PSU banks as a bucket, Nifty PSU Bank Index maybe, has outperformed the private bank index by a wide margin, or by a margin, if not a very wide margin. You are saying the reverse could happen in the next 3 to 5 years?
That is probably my view. Just that the top private sector banks, they're very large in terms of their market caps. And you have roughly, most of them fall in the large cap bucket, but there you have a lot of PSU banks who probably also features in the mid and small cap segment. So if you have a industry-wide or a sector-wise tailwind in the mid and small, probably that can also support PSU banks. My per se view on PSU banks is not very negative, but clearly from a valuations point of view and looking at the sector in the past 20 years, I think whenever valuations are supportive, that is where higher allocation should be. And whenever valuation starts becoming expensive or full, despite of a good visibility on growth, probably the allocation should come down. So when you're already sitting on a lot of good performance and assuming you have allocated well to them, I think it would make sense to move some money or rotate some money within the same sector itself for the next 3 to 5 years.
Okay, just last question on banks, because such a large weightage, I'm inclined. So therefore, would you say that the smaller private banks also have a chance? You may or may not have large allocations there, but I heard you say that the PSU banks have a mid-cap flavor, large private banks, the larger banks obviously don't. Are mid-size or small-size private banks a good play?
Yeah, very interesting. They are a good play in my view, because historically, an investor's mind or an analyst mind, typically the valuations for a mid-cap or a small-cap private sector banks get tagged or benchmarked to the large-cap peers. And in this case, currently the large cap itself is underperforming, and therefore the valuations of the mid and small cap private sector banks are accordingly at much lower than the large cap themselves. Fundamentally, the industry tailwinds is good for them as well. These are generally run by good, credible management, and with very few a few accidents that we have seen in the past. Obviously, there can be pockets where some small bit of tidbits can go wrong. But on the whole, I do not see any great mistakes or any great areas of concern for even the small and the mid private sector banks. So you're right, in a way, outlook remains good for even for the mid cap and the small cap private sector banks.
Now, Sumit, I want to talk about a small subsegment before I move on to the other lending financials, and which is capital markets. When I look at the weightages that you have on capital market stocks, it's also higher. Now, again, is there a technicality here, or do you believe they present a non-linear growth opportunity, capital market stocks?
Yeah, so I think it's more of a non-linear growth opportunity in the segment, and you and me are witnessing this happening in front of our eyes.
Yes.
The sheer number of new investors entering into the market, the number of demat accounts, the number of SIPs in the market, or let's say transactions happening in the cash market or derivatives market, exchanges coming up with differential expiries, weekly options, and experimentation with so many things. And same goes with adoption of technology by traditional brokers, where erstwhile all of us know from we innovated from ringside trading to probably tech-based trading today. The speed at which KYC happens or an account is opened, the ease of doing business. I think all this innovations together is impacting the capital markets in a very, very positive way. And I think these trends are multi-year trend rather than a yearly or a 6 monthly trend. And that is where I think we have, right from the inception of the fund, we have been one of the most heavily invested fund in the capital market segment. And our exposure has been very diversified. So right from full-fledged brokerage houses to mutual fund manufacturers, to financial product distributors, to exchanges, asset management companies themselves, and some of the fintechs as well. So essentially, I would say this segment quite positive in the medium to long term, and I would continue to look for opportunities. Maybe you can find a number of new listings in this space. So if you need to have a slightly open mindset to capture the entire financial services spectrum. Niraj, I would like to bring to your notice one more thing. If you look at the current AUM of all the 20 financial services fund in the country today, it's somewhere between 30 to 35,000 crores. Out of 20 funds, 5 funds have been launched in the last 1 year. And even if you analyze some of the portfolios of these funds, or maybe some of the diversified funds who also have about 30-35% in financials, do you really think the kind of opportunities that we are talking about, a 35,000 crore AUM is good enough to be invested in this opportunity? Definitely not. So a large number of amount of money can actually move into all these subsegments over the next 3 to 5 years, and therefore I think one need to have a different mindset to actually take advantage of this theme.
So are you, Sumit, are you constructive AMC stocks? Are you constructive broking stocks? Are you constructive some of the how do I say, the likes of CDSL, etc.? I'm not asking you to comment on a name, but the facility providers, if you will.
See, I think I would say I'm equally positive about all these 3-4 segments that you talked about, because see, at a macro level, if you look at the penetration level of mutual fund assets to GDP, or let's say number of households investing in investments in the market, or let's say the sheer spending power that people have. In all the comparisons, India as a demography gives you a thought that probably most of the things will stay here for a long term. And if you look at some of the global markets, matrices like MFAUM to GDP, or stock market capitalization to GDP. Those numbers are mind-boggling. So essentially, the entire ecosystem will benefit. Obviously, a few players will do better, a few might do worse, depending on their actions and the way they do their business. But essentially, the tailwinds will be for the entire segment.
Got it. Okay. So capital market stocks, very constructive. What I also found was the weightage that Bandhan AMC in this fund have given to power financiers. There are only two, but between the two, I think it's about a 7% weightage, if I'm not wrong, or circa those numbers. Now, here's the question, Sumit. The stocks have rallied quite a bit. You're still holding them onto the portfolio because of growth opportunities ahead? Because otherwise, I mean, they've the valuations are no longer as cheap. They've also revised their growth guidance a little lower, if I'm not wrong. So why are you still invested? Is this what's the reason?
Yeah, so without going into specific names,
again, yeah, completely.
Yeah, the theme of power finances basically. If you remember 10, 15 years ago, these stocks used to be darling of stock markets, giving you very good NIMs and ROAs. And at the time, the entire power and industrial story in India was doing quite well. However, fortunes changed in the last, I would say, 10 years or so, wherein, merchant power fell and associated problems were there and companies were stuck with bad loans. What it led to was a very attractive valuations for most of these companies, and essentially the problems of asset quality were quite behind, and I would say it was more of an investor apathy to not experiment because they had a bad experience. So essentially, as I said, our style of managing this fund, despite of being a thematic fund, we are very active in managing the portfolio. It's not like a buy and hold portfolio. So the weightages currently are a result of stock price appreciation as well. So obviously, at certain valuations, it becomes more attractive, and at certain valuation, you would look for an opportunity to book profits as well. But structurally, I think this theme can still continue to do well. Obviously, there's a lot of positive stories around it in terms of government narratives and the kind of the new, whenever there's a new government, a lot of things needs to be done on these sectors. So essentially, maybe some tinkering on the weights will be there or would have already happened. But from a longer term perspective, this is a space to be in because this was ignored for a very long time from investors' mindset.
Okay, and that's why Sumit's still comfortable with what he has, which brings me to the final facet, and which is the NBFCs. Now, the regulator has shown, the desire to manage the kind of growth that was happening. In some sense, I don't want to use the term reckless, but very strong growth happening, and in some fashion, maybe some processes may not have been followed, and there has been a bit of a regulatory overhang on NBFCs, Sumit. We can't wish that away. I see you are overweight there. Is there a particular set of lenders on the lending NBFCs that you prefer over the others? What's the construct here?
Yeah, so Niraj, NBFCs, if you see the history in India, they are supposed to be the last mile lenders. They normally reach where probably banks don't reach because banks are very, very well regulated. They might not to take that extra risk, and therefore historically you have seen maybe a 20 or a 30 NBFC for one bank. That has been the ratio. What is good is that today it's quite well governed, enabled by technology, and most of them are actually serving the needs which banks are unable to serve in a very efficient way. So on the whole, structurally, it is a very positive thing to be in. Within that, there are various segments. For example, there are a few NBFCs who works very well in the consumer finance space. Some might in secured, some might be unsecured. There might be a few NBFCs who have worked very well in terms of gold financing. So there are all this niche, and there might be some NBFCs who does a mix of everything. So essentially, and as you say, in the entire ecosystem, not all things go down and not all things go up. So if a company is wise enough to pick and choose the area where he wants to operate, control the risk, and push back when things go slightly bad, I think those are the kind of managements that we would want to back when we invest in those companies. So therefore, again, we have had exposure, or in fact, we have exposure to almost all the segments like leading companies in vehicle finance, gold finance, or consumer finance companies, some of the card companies also. Maybe some of them are doing microfinance as well. So the idea here is for a set of, let's say, 7 to 8 companies which are NBFCs which are operating in that sub-segment, try to back one or two who you believe would do a good job, and create a diversified basket so that risk also gets controlled, and at the same time you capture the opportunity which the market is presenting.
That's true. Okay. Sumit, it's lovely getting a sense from you about the overall construct, and you should be constructive on almost all aspects of this space. If I had to ask you to 1 minute answer, ignore market caps, ignore weightages, from within these 4 buckets, within 1 minute, if you had to pick one as the one which over a 3-year period or a 5-year period will give the biggest bang for the buck, would it be capital market plays? Would it be lending NBFCs? Would it be non-lenders? Or would it be banks?
See, that's a very tough question, but I'll give you an easy answer. Try to invest more where there's more fear and more disappointment in the mind. And that is where you will start making money more than the market. So the spaces which have underperformed, probably allocate more subject to the fundamentals, and do not ride too much on momentum, because that is the flavor of the market today. And that is what over a long term will help you make good returns and grow your portfolio as well.
Okay. Sumit, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time.
Thank you, Niraj. Thanks for having me on the show.
Pleasure was ours. And viewers, thanks for tuning into this leg of the Portfolio Manager.